I think there's enough juice in the system. I think we're going to have economic improvement in the second half, despite the ongoing trade war. But
are we too obsessed with the
risk,
trade war? Are we too media focused on those trade war headlines?
I think so. I think it'd have to be in place for a long period of time, and probably in a much bigger magnitude than just with China, for example, to really have meaningful impact. And what doesn't get enough coverage is how much policy stimulus we've introduced this year, not only us, but around the globe. And with a lag of about 6 to 8 months, you're going to see that start to improve, I think, conditions here and in China and in Europe. And I think that's what I think is going to happen. But I am worried, Brian, about the inverted yield curve causing a lot of panic among investors, myself included. If it lasts, it's been such a great recession indicator. And what I think the Fed, if they do cut rates, number one, they've got cover. Inflation's rolled over, growth reports have gotten weaker, the bond vigilante is giving a strong message they need to cut. But more importantly, if they cut, I think they remove that inverted yield curve out of the mindset of investors, and you reduce the risk of a panic freeze-up in the financial markets.
We got to make it clear, though, that the yield curve you're talking about is sort of the mini curve, right? I mean, it's the puppy. It's the 3-month, 10-year. It's not the 2-year, 10-year, Jim, and there is a difference. There is a difference between what those two things may signal.
You're exactly right, Brian. We've not had the 2-year, 10-year inversion, which you normally would have. But you can see, taking that 10-year down to 2.08% there last week, you can see the panic there is surrounding that yield curve, I think, in my view. And the Fed can eliminate that risk, which I think is almost a bigger risk than the trade war taking the fundamentals down.